Welcome back to the Money Hour with your host and mortgage expert, Tina Mitchell, right here at 1150 AM KKNW, the Saturday, July 4th, the show. I hope you're enjoying time with your family and friends, maybe getting out and enjoying a little bit of the sunshine on this Independence Day. My goal is to keep you up to date on the latest news and trends in our local economy. Keep me tuned in, and I will definitely keep you informed. If you're listening to my show at a different time or day, you are listening to a rebroadcast. You can call the show at 1-855-400-1150. Again, that's 1-855-400-1150 or online at themoneyhour.com to discuss anything regarding money with myself or the guests that I have in studio today. And right now I'm having a conversation with Gary Cassill with Mountaintop Advisors LLC, a great resource to help advise you on how to manage, grow, and maintain your money. More money is a little bit less stress. Wouldn't you agree, Gary?
More money is usually better.
A little bit better. So thank you so much for coming into studio. I'm excited. The first time I've had a conversation here with you. So excited to hear your expertise and sharing with my listeners.
Well, thank you so much for having me, Tina. I appreciate it.
A little bit about Gary. He's first licensed in 1984. Gary's been in a high volume bank program and at a very well-known credit union. He has a Series 6, 63 and Series 7 license, in addition to being fully licensed for life insurance and annuities, both fixed and variable. He's been a top producer many times throughout his career, board member of Auburn Rotary, formerly Boy Scout adult leader, and also, which was kind of interesting and exciting, volunteer at Seafair for over 36 years and counting, which means you'll continue to do it in the future as well.
Yep.
How exciting. I'd like to be a volunteer over at Seafair.
I think we can squeeze you in.
Yeah. Do you do it over at Tri-Cities too, or just here in our...
No, just here.
A little too hot in Tri-Cities, especially with the weather that we have coming in. So let's go ahead and talk a little bit about your arena and money. Investing in low interest rate world, lots of opportunity. So if interest rates are at the all-time lows, what will happen to bond values when they go up?
It's sort of like a teeter-totter. Values plummet when interest rates go up. Mm-hmm. It's very simple math. And the dangerous part is that they will go down as a multiple of what the interest rates go up. Mm-hmm. So we saw that in 2013, interest rates went up not quite a percentage point, and the safest investments out there, 10-year treasuries, went down 14.1%.
Yeah, wow.
So if you're only earning 2% on your investment and it goes down over 14%, you've kind of lost 7 years of gains in a 2-month period of time.
Yeah, unbelievable. And, I've in educating clients, because mortgages is what I do full time in my arena, just educating clients on mortgage interest rates, just understanding that they're tied to the bond market. So when the bond markets are trading lower, interest rates are going up. When the bond market's trading higher, interest rates are going down, mortgage rates. And usually opposite the stock market, there's been a little crazy stuff going on in this unique financial arena that we've been in. But usually your investors are either investing in the stock market because of the great economic news and want a higher return, or they're investing in the bond market for a little more security when there's some economic news that's not so exciting. What are you seeing right now that investors are doing in the bond market?
A lot of them, a lot of the clients that I've been dealing with don't know how much they've got in bonds. That's the part that's really dangerous to me.
Yeah,
if you think about it, a lot of them are in 401ks.
Makes sense.
And in the 401k, the easiest solution is to pick one of these target date funds. Like if I don't know if any of your listeners are in that, I'm going to retire maybe in 10 years from now. They would look and say, well, I've got this fund that's a 2025 fund, and it's supposed to start off aggressive and then gradually taper off and professionally managed. Yay, let's do that. That's easy. Check the box off and ignore it. Fidelity Investments is a pretty big player in that arena.
Sure.
Their 2025 fund is 25% in bonds currently.
Wow, I didn't realize that.
So if you've got 25% of your portfolio is in bonds and interest rates are staged to go up at some point, you're about to get hurt, and they're not going to know why.
Yeah. So really understanding and understanding where your money's at, whether it's where it's being played at.
Exactly.
Yeah, makes total sense. So how about if we talk about the stock market, if the stock market is at all-time highs, where are the buy low opportunities?
To me, there are some stocks that are probably you could buy in now at all-time highs and still probably perform pretty well.
Okay.
But it makes me kind of nervous. I mean, I've been doing this for a long time, but I'm still kind of nervous about the stock market in general because it's gotten more volatile every 10 years.
Yes.
So you've got some very large players that are doing electronic trading, and they can make a bunch of trades, per second, and kind of push pricing up and influence pricing, and then they can actually avoid those buy orders, but they've pushed the price up, and then they can sell their own holdings and make some money. Sounds like manipulation, and I think it'd be very tempting. Yeah. If you were in a position like that to do some of that type of stuff. So I get nervous about the smaller investors, not because they don't have that option. They can't play that game. So that's what's made it less stable, more volatile. So to me, when I look at the overall picture of what investments are available and where are the buy low opportunities, commercial real estate.
So how does your average Joe go out and purchase commercial real estate? Because aren't you looking at millions of dollars to do that?
You would if you were going to buy one building and go do it conventionally. And
so share some creative ways for my listeners to get into commercial real estate.
Well, the easiest way to do it is through a thing called a real estate investment trust. And a real estate investment trust, you've got some professionals that are buying, analyzing, and selling commercial property in a bundle. They get a whole portfolio of these buildings together, and they're collecting rents. And they might be a specialist in one particular area, like apartments or office buildings, and they might be they might specialize down in the South or in the East Coast. But they have a track record that you can look up, and in fact, in their prospectus, they're actually required to tell you how they did on all of the previous ones that they've done, that they've put together. So you can do the research.
What sorts of average returns would you be sharing with your clients as far as on real estate investment trust? And is there a real estate investment trust index to compare maybe to the S&P 500 index?
Yeah, that's a great question. The problem with real estate investment trusts and real estate in a 401k or in an IRA or however you want to invest is that a lot of people don't know about them. It's been kind of kept semi-quiet. They're considered alternative investments, and there's several different types of alternative investments, commodities and BDCs and some other stuff. I really only wanted to talk about the one because it's confusing enough as it is.
Learning something new can be confusing.
So if Oppenheimer Mutual Funds did a study in October they released a study in 2012, October, and they said that no matter what time frame you look at, if you take all of the real estate investment trusts that are available, the good, the bad, and the ugly, and that makes up the index, and there is a REIT index. And you compare that to the S&P 500 index, which is what most people invest in. The 500 largest stocks in the U.S. So if you take you compare those in the 1 year, 3 year, 5 year, 10 year, or even 15-year histories, REITs outperformed the stock market.
So if they're doing so well and performing so well, why are you not seeing more investors investing in them?
I think it's because they don't know about them. In fact, let me elaborate on that. If you go even farther to 20 years and 25 years and even 30 years, still the real estate investment trusts have outperformed the stock market. And you would think after 20 and 30 years that's enough time for people to be educated and understand this great opportunity. You'd think. I think that part of the reason why the message doesn't really get out is because the large brokerage companies have got they've got a program that they've been doing for a long time. It's been profitable. And they're very large animals that don't move real quickly. And they're kind of lumbering giants, and I don't think they like changing. It's like trying to make a battleship.
Makes sense. Direction. Makes sense. So what type of investor do you see is using that has a good amount of real estate in their portfolios?
The big investors.
Yep. Okay.
So if you take a look at some of the endowments, if you've got Stanford and Harvard and Yale, these big endowments, donors that have graduated from there that want to keep promoting their school, they will donate a bunch of money, and that goes to scholarships to get more bright kids in there, and that in the future will also donate money.
Okay.
Those investors, they've got some pretty sharp people investing those funds, and they have been making huge changes. So if you take a look at Yale as an example, Yale has reduced the amount of domestic stocks in their portfolio. Looking from 1985 to 2012, they reduced the amount of U.S. stocks by 92%. That's a pretty big change. They also dropped the amount of cash and bonds in their portfolio by a substantial amount, and they've increased the amount of real estate in their holdings by 120%.
Wow.
And you might ask, why are they doing that? They need consistent income, kind of like a retiree does.
Okay.
They need consistent income because every year they need to be able to give out scholarships, and they need to be able to, pay staff and all of those sorts of things. So they're not trying to hit a home run, but they do want to get a consistent earnings. And the people that are potentially going to donate some more money want to know that they're not mishandling things and missing the boat.
Sure.
So they've been doing very, very well. In 2013, Yale said, hey, we earned 11% over the last 10 years. The typical investor that was looking at a 60-40 stock split, which is highly recommended, very common. 60% stocks, 40% in bonds. You divvy them all up in different categories, but you end up with that. They only did 6.8%. So 11% versus 6.8.
Yeah.
Pretty big difference.
Yeah. And I think, I personally think it's it's important to be diversified, have a great piece of your investments in all asset classes, real estate, the stock market, the bond market, and just, make sure you're getting all of the information so that you can make the best decisions on investing your money. Now, in getting more information on real estate investment trust, how do investors get more information on how to participate in this?
Generally, they're going to have to go to a broker, an investment advisor of some sort. And you want to make sure that person's been doing it for a while and understands. Because I remember when I first got introduced to these things, that was pretty exciting. And I looked at some of the things they were doing, and it made a lot of sense to me, and I got real fired up. And fortunately, I found out that some of these programs didn't work very well, and there were some problems. So you do need to kind of decipher which ones are actually valid and which ones are smoke and mirrors.
So I was going to ask is, as far as risk, what would be an additional risk or the risk side? So that would be one of them, just not investing into the right one. What other risk do you see are attached with that? Like we have risk in everything else that we invest in. Is there any unique?
Well, I think the biggest thing with real estate investment trusts is many of them are illiquid.
Okay.
So you have to be able to say, I'm going to put this money in there.
Yes.
But I do not need it, and I will not need it for at least 6 years.
Got it.
And I've had clients tell me that. And then 3 years later, they're saying, hey, I want to help my daughter buy a house, or I got this thing I want to do, and I kind of need to pull that money out. I'm like, wait a minute.
That's another reason diversification is good. You want to have liquid assets, and you want to have other ones that are not as liquid, because in that there's, so there's always that balance in that way. If you've got your liquid assets and maybe these investments, real estate investment trust being one of them, you've got some upside, but a downside being that it's not liquid. You can't get to the money as quickly. Correct.
Some of them are illiquid.
Yes.
So yes. So that would be a reason to, limit the amount that you've got in there.
Okay.
So that in case something comes up, an emergency does, you're ready.
So how else are you advising your clients right now to really take advantage of the opportunities out there and to be financially smart with where they're putting their money?
As much as possible, like what we were talking about a little bit before during the break, is being better savers.
Yes.
And, thinking a little bit more before spending money. use of credit cards isn't necessarily evil, but there's an awful lot more debt now than there used to be, and people are used to it. It's been so. I think paying more with cash, buying what they can afford instead of trying to have the coolest car, etc. Yeah.
Being smarter with our money. You think that maybe that we've learned something from some of the challenges that we've gone through, and being a little more cautious of how we're spending, managing our money better, saving for the future, and really doing the research that's needed when making an investment decision.
Exactly. And some of the things you talk about when it comes time to buy a house, what we were talking about on the break, and be cautious. You don't necessarily have to fully extend yourself just because the bank says it's okay. So,
Gary, we were talking about residential real estate with Erik a little bit earlier in the show today, and talking about the issues that are going on, really being able to determine what the actual value of the property is. Now, talking with you, talking about commercial real estate, what's the difference between coming up with value for commercial versus residential real estate?
That's an interesting thing. There's a lot of things that come out. I'm not a commercial appraiser, but what happens is, if you think about having 2 pieces of vacant land, commercial land.
Okay.
One, you bought it and you're thinking it's going to go up in value later on. It's on the main drive. Right across the street, there's the exact same size, and yet it's being rented out as a parking lot. So there's income coming off of it.
Okay.
So exact same pieces of property, just one on one side of the street, one on the other. The one that's got rental income obviously is going to be worth more money.
Of course.
So if you've got an office building and it's 50% occupied versus the exact same size building across the street that's 80% occupied, the 80% occupied building, because there's a lot of income coming in, is going to be worth an awful lot more. So one of the things when these real estate investment trusts are buying these buildings, they're looking at, can I improve the value by bumping up the amount of occupancy in it?
Okay.
Can I sell off part of the property to maybe the next door neighbor who wants to build a parking garage for his building?
Yep.
And we still have the same amount of income coming in, but now we've sold off some of our property.
So kind of could be like real estate when you get a property that might be distressed or in not as good of a condition. In your worst situation with commercial, we're talking about income revenue, but maybe we're in this residential, if you're talking about the condition of the home, you can get a really good deal on that house. And then if you're willing to put the money or put the work into it to get in a better condition, now you've just made a lot more money. Do you see that? And could that work the same in commercial as well?
Absolutely.
And seeing what the opportunity is with an asset that maybe is not as appealing to the massive.
Yes. So basically what you end up with is, I kind of look at it, there's 2 different types of properties. One would be an opportunistic property where, yes, with the right experts coming in, they can paint it up, fix it up, and improve the value by quite a bit, and then turn around and sell it later on. And the other one is the client says, I don't want to have any risks. I want to have a building that's almost 90%, 100% occupied, steady income, well-maintained, Class A.
Makes sense.
Yeah.
Well, what a great topic to bring to my listeners. I appreciate a little bit different spin on investment opportunity and some things that maybe that you're not aware of as a listener. So thank you so much for coming in to talk with Gary. Feel free to call the show at 1-855-400-1150 or online at themoneyhour.com. Gary, thank you so much for coming in studio. I so much appreciate it.
It's my pleasure, Tina. Thank you very much.
You're welcome. This is Tina Mitchell, your host and mortgage expert, signing off for the day. Enjoy the rest of your weekend. Enjoy your 4th of July. Great weather, great place to live here in the Northwest, and I appreciate all of you listening to the show. I'll be here next week, same time, same place, right here at 1150 AM KKNW.